The most powerful currency on Earth is being quietly dethroned, and Washington just woke up too late. No bombs, no tanks, just code. China has launched a financial weapon the US can't sanction, can't block, and can't even catch. The digital yuan is no longer theory, it's operational. A new global hub just went live in Shanghai. 6 major foreign banks are already on board. US exporters are beginning to settle trades outside the dollar. And while Beijing builds the future, Washington is frozen in crisis. Trump's calling for emergency rate cuts. The Fed is paralyzed in stagflation, and $1.2 trillion in interest payments is about to detonate through the core of the US economy. This isn't a forecast. It's the opening move of a financial world war. And America's $2 trillion deficit is about to be thrown into a marketplace that no longer wants dollars. So what happens when the world stops needing them? But America keeps printing anyway. The dollar, once the unshakable pillar in global crises, is slipping. Normally, geopolitical conflict sends investors rushing into US assets. But since Trump returned to the White House in January 2025, the dollar has plunged more than 10% against major currencies. The ICE US dollar index dropped below 99 in May, a 2-year low. Oil is soaring past $93 a barrel, normally a tailwind for the greenback. But this time, investors are fleeing. They're not buying dollars, they're dumping them. Why? Confidence is cracking. Washington's fiscal policy is erratic. Debt ceilings are a game of chicken. Sanctions have been overused to the point of fatigue. Global markets no longer believe the US can manage the privilege of reserve currency status. The dollar's failure to rally in wartime isn't just a fluke. It's the first fracture in a much deeper shift, and it gets worse. In trying to fix the trade deficit, Washington is making the dollar problem worse. Cutting imports means cutting off the global supply of dollars, exactly what the world relies on to buy US assets. According to Reuters, America's current account deficit shrank to just $28.4 billion in Q1 2025. Down from $245.6 billion a year ago. That sounds like progress. But those missing dollars aren't circulating. They're not returning to buy treasuries. They're vanishing, and so is foreign demand. Bond markets are already flashing red. A recent $40 billion treasury auction saw indirect foreign bids drop by 22%. Japan and Saudi Arabia are pulling back. Some are shortening maturities. Others are walking away entirely. The dollar's lifeblood, its global pipeline, is drying up, and China is standing by ready to replace it. At the Lujiazui Forum in June, China made its move. PBOC Governor Pan Gongsheng delivered a clear message. The age of single-currency dominance is over. Backed by aggressive state policy, Beijing is expanding the digital yuan, launching an international payments hub in Shanghai, and onboarding major foreign banks like Standard Bank and First Abu Dhabi Bank into its cross-border system. The yuan has already appreciated 1.1% this quarter, and now handles about 30% of China's trade. China's ambition goes beyond replacing the dollar. It's about building a new system where no nation can weaponize money. The strategy? Capital account convertibility, UN-denominated futures, increased use of the IMF's SDR basket. They're not trying to collapse the dollar. They're just making it unnecessary. And that, more than anything, is the threat, because this wasn't supposed to happen. Not yet. 2 years ago, even China's most bullish projections didn't put the yuan in striking distance before 2030. But something changed. US fiscal chaos, investor outflows, global fatigue with American dominance, it all accelerated the timeline. According to Bloomberg Economics, the dollar's share of global reserves has dropped from 59% in 2021 to just 51.7% now. The erosion isn't gradual anymore, it's speeding up. And the US isn't steering this transition, it's chasing it. The world isn't waiting for America to catch up. It's already moving on. As of May 2025, the US dollar has reached a 25-year low in its global dominance, a historic shift that's sending ripples through international finance. At the same time, the euro and China's digital yuan are steadily gaining ground, climbing in market share thanks to new trade and settlement systems that make it easier and faster to use alternative currencies. Christine Lagarde's unusually public visit to Beijing, where she endorsed a global euro moment, highlights how this multipolar shift is no longer just theoretical. It's a carefully coordinated move among global powers to reduce reliance on the dollar. Even US-based multinational exporters, who once operated almost exclusively in dollars, are now hedging contracts with dual currency denominations because of rising currency volatility. What began as a slow, incremental diversification is rapidly accelerating into a real-time migration, and the sheer velocity of this change might prove the most destabilizing factor of all. Meanwhile, the Federal Reserve's June 2025 economic outlook paints a textbook example of stagflation, a problematic mix of slowing growth and stubborn inflation. The Fed has revised down GDP growth for 2025 to 1.4% from 1.7% just a few months ago. At the same time, core inflation is projected to rise to 3.1%, up 0.3 percentage points, while unemployment is expected to climb to 4.5%. The Fed chose to hold interest rates steady at 4.25% to 4.5%, pointing to elevated uncertainty, as Chair Jerome Powell resists political pressure to ease monetary policy. Former President Trump, meanwhile, has ramped up his criticism, demanding rate cuts of at least 250 basis points to stimulate growth. But despite the pressure, Treasury yields remain elevated, and interest payments on U.S. debt are forecast to top $1.2 trillion this year, a figure that now exceeds defense spending. Powell's stance reflects clear economic signals. Consumer demand is weakening, with retail sales dropping 0.9% in May, and housing starts falling to a 5-year low. The Fed is caught in a difficult bind. If it cuts rates, it risks stoking inflation. If it holds rates, it could deepen a recession. This policy impasse is eroding the dollar's global appeal, trapping it in a vice of its own making. At the same time, China has quietly built a financial infrastructure designed to sidestep traditional sanctions and Western-controlled systems. At the June 2025 Lujiazui Forum, People's Bank of China Governor Pan Gongsheng announced the launch of a digital Yuan International Operations Hub in Shanghai. This hub is engineered to speed up cross-border settlement of China's electronic currency, ECNY, across Asia and further abroad. According to Reuters, 6 major foreign banks, including Standard Bank and First Abu Dhabi Bank, have already joined China's cross-border interbank payment system, CIPS. This platform allows for instant yuan-based settlements without relying on the SWIFT system, which has long been dominated by the West and vulnerable to political influence. Pan openly criticized traditional cross-border payments as susceptible to politicization, signaling Beijing's strategic intent to embed the digital yuan deeply within global trade pipelines, neutralizing the power of U.S. sanctions. Bond traders and investors are watching closely as China explores launching yuan futures contracts, a direct challenge to dollar index derivatives. Analysts at Morgan Stanley have called this move the most concrete step toward renminbi internationalization, since the yuan was included in the International Monetary Fund's special drawing rights basket in 2016. But there's a critical detail that hasn't made headlines. If transaction volumes on CIPS surpass those of SWIFT in Asia's major trade routes, the dollar won't just lose influence, it might lose visibility altogether. Major exporters are not waiting around for a geopolitical shift, they're actively rewriting invoices. Bloomberg reports that more than 30% of China's cross-border trade is now settled in yuan, marking an all-time high. Meanwhile, insiders at U.S. Bancorp reveal that American firms are quietly adapting by offering dual-currency contracts to Asian partners. In April 2025, 6 BRICS-aligned economies moved to standardize commodity pricing in non-dollar terms, citing growing volatility in U.S. fiscal policy. Around the same time, Russia and the United Arab Emirates finalized a multi-billion-dollar oil deal denominated in yuan, bypassing the traditional petrodollar system entirely. Even major U.S.-based companies are hedging their exposure. Caterpillar, in its latest earnings call, disclosed that it had expanded foreign exchange swaps in local currencies to offset dollar instability, especially in emerging markets. According to the IMF's April bulletin, global reserves held in U.S. dollars have fallen below 52%, a level unseen since 1999. This is no longer an ideological shift, it's a tactical one. Every trade settled in yuan peels away one more thread from Washington's financial safety net. President Trump may want a weaker dollar to boost exports, but he still depends on a strong dollar to fund a record $2 trillion budget deficit, nearly 7.3% of U.S. GDP according to the Treasury's May 2025 estimates. At the same time, he's escalating tariff threats against Iran, China, and the European Union, adding to cost-push inflation and tightening the Federal Reserve's already narrow policy margin. Meanwhile, China's economy is outperforming expectations. Its second-quarter GDP growth was revised upward to 5.4%, with exports rising 1.1% year-over-year despite global slowdowns. Chinese state-owned enterprises are increasing foreign bond issuance denominated in yuan, effectively testing the waters for a truly multipolar currency model. This ongoing currency war pits deep structural contradictions against each other. The United States requires cheap borrowing costs and global trust to sustain its economic model, yet its policies are undermining both pillars. Beijing, in contrast, is betting on steady, incremental gains through central planning and building a de-Americanized settlement system that attracts capital. There is no balance here, only a countdown to see which system breaks first. The board is set. On one side is a U.S. economy burdened by $37 trillion in debt, rampant political volatility, and a currency that is too central to fail yet increasingly too erratic to trust. On the other stands a rising yuan, digitized, centralized, and backed by strategic infrastructure rather than slogans. The question is no longer whether the global currency order will change, it's who will be left behind when it does. What happens next won't just affect sovereign balance sheets. It will determine whether your next mortgage, your job, your retirement, and your country's global leverage are priced in dollars or something else entirely. So before you click away, consider this. If you had to make a choice today, which system would you trust with your savings? Drop your answer below, because the next move isn't coming. It's already underway.